Welcome to Trading 101, brought to you by Futures Classes. If you are stepping into the futures market, you need to understand the foundation of it all, the futures contract. A futures contract is a legally binding agreement to buy or sell a standardized asset at a predetermined price at a specified date in the future. For example, a single crude oil contract might specify buying 1,000 barrels at $75 per barrel, expiring in December. Once you enter the market, you take a position. Taking a long position means you are buying, expecting the price of the underlying asset to rise. Taking a short position means you are selling, expecting the price to fall. Futures trading involves margin and leverage. You don't need to put up the full value of the contract up front. Instead, you deposit an initial margin, a good faith performance bond. Through leverage, a small amount of capital, like a $5,000 initial margin, can control a much larger notional value, such as a $100,000 futures contract. However, if your account equity drops below the maintenance margin level, your broker will issue a margin call, demanding you deposit additional funds. Every contract has a defined contract size, like 1,000 barrels of oil 4/CL. Price movements are measured in ticks, which are the minimum price fluctuations. Every contract has an expiration date. When it arrives, obligations are settled in one of two ways: cash settlement, where parties simply exchange the financial cash difference based on the final settlement price; physical delivery, where the actual underlying asset is delivered. To gauge market momentum, traders look at volume, the total number of contracts traded during a specific period, and open interest, which tracks the total number of open contracts still held by participants at the end of the day. Finally, futures positions use a mark-to-market system. At the end of every trading day, typically at 4 p.m. Eastern, profits and losses are calculated daily based on the current settlement price, and your margin account balance is adjusted accordingly. That price then becomes your new cost basis for the next session. Stay tuned for our next lesson in the beginner series. Thank you for joining us. Make sure to like and subscribe.